around stuff, money, and I think I need some more intro to investing. So this will be part 7, whatever, but it'll say continuation of introduction to investing. And uh, money is, I know why most people don't try to learn it because it can get complicated. There's a lot of aspects to it. But you have money, or you wouldn't be even thinking about it. Investing. Okay, so I kind of covered it in the last one, was that there's debt obligations that you can own from federal government, treasury bills, treasury bonds. You can own debt obligations from the state that you live in. They issue bonds. Municipal bonds is what they're called. They issue those all the time. And bonds that were issued 10 years ago are probably for sale. Somebody's decided to sell them. You can buy those. Um, Equities, stock. Sometimes, like the electric company in this area, they'll offer the residents who use their services, periodically they'll offer, you can buy our stock. Um, and you can roll it into your electric bill or something, and you can buy so many shares of stock each month or whatever you want. And that's one way to own part of a corporation is equities, and that's what that's about. And the stock market primarily deals, or Wall Street primarily deals with equities, stocks, and variations of stocks, gold, metals. Okay, how you can invest in these things? You can certainly go to a broker, a brokerage company, and say I want to buy 500 shares of Coca-Cola or Ford or IBM, whoever you want. There's also online services like Charles Schwab, other websites, trading vehicles that you can buy equities. There are even bond trading sites on the internet where you can go and buy a bond. Now, in the case of bonds and stocks, you never actually physically get the bond or a stock certificate. You're not gonna. That's not gonna way it work. It's gonna be held electronically at a website, and this is even true if you use the brokerage or bank. Some banks they have a division. It's separate, but they have a division where banks can buy and sell and trade various investments, and they're held electronically there. Okay. Um, Besides web trading sites that you can use yourself, there are a whole raft of what's called mutual funds. Okay, what is a mutual fund? There's some guy somewhere who says, okay, I know a lot about, and pick one, healthcare. I know a lot about healthcare. And there are a lot of companies in the healthcare market, from drug manufacturers to hospital systems, for pay hospital systems, to, I don't know, instant minute clinics. All these sort of things can be companies. And this guy knows all about healthcare and how it goes. So he says, you give me money, I'll invest it in equities and maybe even the debt, I don't know, of this sector of the economy, healthcare. And by you investing and other people investing, and he's a registered investment arm, and the Securities and Exchange Commission know him, he then can manage that pool of money in that particular sector and buy and sell investments in that sector as he sees fit. He sees, oh, there's a good opportunity over here, he'll buy the stock. He may sell something he already has, so on and so on. That way, you're just a member of a group that owns shares or debt or whatever it is in a specific category. Now, there are mutual funds that invest in what's called the Standard and Poor's 500. And what they do is they take your money and they invest it in all of the companies that are listed in the Standard and Poor's 500 list. Same way with the Wall Street 100 or whatever it's called, the biggest corporations in America, the blue chips, if you will, is what they're called. They'll invest in those, strictly in those. Um, Mutual funds, there's a ton of them. Lots of people offer them. You can buy them directly from the mutual fund company. You'll find those online too. And there's a lot of them. Fidelity, Vanguard, T. Rowe Price. There's just tons and tons of different ones. And there is a manager of that particular fund. And he may have a whole staff, but they take a share of the return that they get on the management of all the investments underneath of in their portfolio that you are now a member of, you're part of, you're a owner of it, I guess, in a sense. Okay, that's a decent way. One of the principles of investing, which I left out and should have said, is you never put all your eggs in one basket. What does that mean? Well, you don't put all your money in just one stock. You don't put all your money into one bond. You need to spread it out. And if you had a brokerage, you had a broker, he would tell you that you want to have a mix of equities and what's called fixed income investments. And fixed income investments are where they pay you interest on a monthly or annual basis or whatever it is. But your principal is relatively assured you'll get it back. And on the equity side, you're really looking for the stock growth. That's where you see growth in your equity, your total value of you invested 5,000 and 20 years from now it's worth 50,000 because the value of the stocks that were in that investment portfolio have gone up in value. So you want some kind of growth aspect. The fixed income part really isn't going to grow. You're just going to get interest off of it. But the point there is that your principal is relatively secure. Um, Now, with mutual funds, that's not necessarily so. There are bond mutual funds, and what happens there? You buy in, and they load up their portfolio with all sorts of bonds from governments, state governments. Walt Disney issues bonds, so does other corporations. They issue very long-term bonds sometimes. They load up their portfolio with bonds, and the other aspect of a mutual fund, there are people who periodically say, well, I need all my money. So the bond, whoever's managing that particular mutual fund, be it equities or fixed income, they may have to sell something when they don't want to. They only carry so much cash to respond to client needs for money. Uh, and this happens when there's a stock market implosion or maybe something in the world, some sort of crisis, a war or something, and people get scared and they say, well, I want my money. I want my money back. And what happens is the manager doesn't really want to sell what he's got, but he has no choice in the matter. So he may have to sell an equity for which he paid $20 a share, and he's got a ton of it. He probably bought it at various share prices, but he's got a lot of it at $20 a share, and the stock has gone down to $15 a share. So your portion of that, you're not going to get back all your principal. You can lose money in mutual funds. because of that. They are, it's not you're the only investor. There are lots of investors. And their aversion to risk goes up and down, and they decide they need the money, they're going to buy a house with it, which is another form of investment as real estate. I also forgot that to mention that. There are what's called real estate investment trusts. You give them money, they go buy various commercial real estates around the country, and they collect the rents off of those, and they manage the properties and so on, and you get a share of the return on the investment that they made for you and other investors. Okay. Same again. Real estate investment trusts may own a ton of office space right now. And after the pandemic, a lot of companies, everybody worked from home. So office space is a glut of it right now. And companies who invested in that are not getting the income that they were used to. So you're not going to be getting the income you might have normally been getting on an annual basis or however you got it from a real estate investment trust. And if you decided you had enough of that and you need to cash out, you may not get your total amount of your principal back. Is what the value of, if you will, the shares you have now, what are their value is, and your money is at risk. Mutual funds are, like I say, real estate investment trusts. There's one sectors that just involved with telecommunications. There are mutual funds that invest in overseas, like China. They buy Chinese stocks and they manage those. There's mutual funds invest in companies in Europe. If you think Europe's going to be hot in the next so many years, then you can do that. Um, uh, Various investment vehicles are open to you. You can do it off the web. You can go to a brokerage company, and those are always listed all over the web. Everybody and his brother offers his brokerage services. You can, in fact, sign up an agreement with a broker and pay him so much a quarter to manage your money. And a lot of people are comfortable with that. They don't want to know all about this and that. And they don't want to have to know what to do when things turn bad. Should I sell? Should I hold on? Should I buy more? There's another investment rule, and I've left these things out. Never catch a falling knife. Well, okay, what does that mean? I had a friend, and he did this all the time, and it was bad. It couldn't, but it's human nature. He thought that private prisons would be a good stock to own because the criminal rates are up, and states wanted to get out of the business of owning prisons and having to deal with pension funds for all of the employees that worked at the prison and all that sort of thing. So there were companies who started private prisons. These were companies, they sold stock, they hired people, so on and so on. And for a long time, they did really well. The states were happy to hand off the prisons to private corporations. Well, there was mismanagement. You know, they didn't have enough guards to take care. The food wasn't right. The health care wasn't up to snuff, whatever. And a lot of these companies got into financial trouble. And they also started getting, inspections by the state and so on. So anyway, he had invested a pile of money in this particular sector, and it started going down. So instead of looking at it like, oh crap, maybe I should get out, he said, no, this would be a great time to buy more because I really believe long term this is going to be a good investment. So stock price dropped $5 a share, and he would buy more of it. And then 3 or 4 months later, it dropped again. Well, it's still sinking. Okay, well, who wants to take a big loss? He committed to it. He's got shares at $20 a share. It's now worth 5. He's not going to hardly get anything back. So what's he do? He buys more. Because if it starts going up, then the shares he bought at 5 will have a growth. In fact, they might go to 8, 10. He'll get some of that that he's lost on his 20 back because it went to 8 on his 5. You understand what I'm saying? That's catching a knife as it's falling. The stock is going down, but you believe so heavily, and you don't want to lose the money you've already put in, so you throw more bad. What is it saying? You throw good money after bad. That's another principle investing you should keep in mind, and we're all subject to that. It's just human nature. You committed to something in a big way, and you thought, oh no, you fell in love with this particular stock, and now it's turning tails on you, and you go, well, maybe just a little bit more. It's like gambling. That's exactly what it is. Not a good idea, but there will be times when things look bad, and you will have to sell an investment. Situation changes. You're temporarily laid off from a job, and you need money, so you'll have to sell one of the investments you have, be it mutual fund or dip into your savings account or whatever you have to do. There's a lot there to contemplate if you know enough about it. Which one of your investments should you sell out, or you spread it over all investments you own and only you only small portions of them. Lots of implications there. When you sell an investment, there may be a capital gain or loss, which is taxable. You buy something at $20 a share, you get sold it at $40 a share. If you sell it within 1 year of buying it, you're going to be taxed on what's called short-term capital gains, which is 30% or whatever it is. It's a lot of money go to the federal government and state governments. Okay, if you hold it for 5 years and you sell it, then it's taxed at a long-term capital gain rate, which is lower, but you're going to pay tax on that. And some people will sell something and they forgot that they're going to owe long-term capital gains on it, and then they get this document in the next year and it's been reported to IRS and they've already spent all the money. Not a good idea. So if you're going to do any investment, you need to start learning about taxes, which is another aspect you cannot ignore when it comes to investment. I don't care if it's a certificate deposit or a savings account in a bank where they pay interest. That information is going to be reported to the IRS, and you're going to have to include it on your annual income tax statement. And if you got a lot of it and you haven't planned for it, you're going to have to come up with the money somehow. Okay, this is more introduction to investing. Bonds, one of the aspects of those, like municipal bonds issued by the state of Virginia. I live in Virginia. Those bonds are exempt from federal taxation, and they're exempt from state taxation. So if I get 4% on a Virginia municipal bond, I do not have to pay any taxes to the federal government on it, and I do not have to pay any state income taxes on it. Now, if I owned a bond that came out of Oklahoma, again, I don't have to pay federal income tax, but I would have to pay probably income tax to the state of Virginia on the interest that I got out of the state of Oklahoma. Again, complications. One of the things you probably don't know, which I think is interesting to football players, basketball players, actors, actresses, all those sorts of people. Let's take football players as an example. You probably do not know, but every time they play a game in one state or another, whatever portion of their annual, whatever contract they had, say they get $10 million a year in pay, okay, if they play in Texas just one game a year, they have to figure out that $10 million salary, they played 16 games, how much should they make in that one single game that was in Texas, and they have to report and they have to file an income tax return to the state of Texas for the income they got while they were resident in that state playing that football game. And that's for every state the teams play in. So 16 games, yeah, 2 games are probably played in your home state, wherever you live, wherever the player was. But 14 other games are played in other states, and they all want to share of the income you made while you were in their state. So another aspect of investing is having accountants, unless you're going to do it yourself. Now I'm talking about big piles of money here, because a football player, 10 million a year, or gets whatever. Uh, Most people don't have to have an accountant do that. Although most people, you do use tax people at tax preparation time. And if you're going to do investing, you have to keep track of all your investment statements, and this stuff will come in and you'll get paper on it. And you have to turn it over to your tax attorneys or whoever prepares your income taxes. Taxes is a big portion of investing, and you should consider it. Uh, at one time, I got sick of the stock market, and I moved over to municipal bonds, so I could totally forget about federal and state income taxes. And that worked okay for me. If I get 4%, that's considered after taxes, a return, if you will. Now, to get 4% after state and federal income taxes sort of depends on your income bracket, but if you're a high income earner, which you probably have the money to invest, then the government's going to take a chunk of that every year. And you're probably going to have to make 6, 7, 8% on your money so you get an after-tax return of 4%. Okay, that is an advantage, and you should consider municipal bonds in your portfolio. Not all of it, not all eggs in one basket. You don't ever do that. Some people, they invest, they say they are invested because I have an IRA in what my company, I have all my stock in the IRA in my company. Okay. Well, there was a case years ago, there was a company called Tile or something, I don't know, like that. And they required, you could have an IRA with them, and all it could invest in was stock in that company, period. I think IBM one time was the same way. They had a pension plan or whatever it was, and it was totally populated with IBM stock. Okay. Well, in the case of the Tile company, they went bankrupt. They didn't have any money to pay the IRAs, the pensions, any of that stuff. Now there is what's called the Pension Benefit Guarantee Corporation. It's a federal organization which pension funds have to pay into annually. It's like an insurance policy. So if something happened to the pension fund, the pensioners would get their payments through the Pension Benefit Guarantee Corporation. But there are odd cases. I ran across I don't know it's required that a pension fund enroll in the Pension Benefit Guarantee. I'm not sure of that. Probably they do. But as far as I know, and this is another interesting aspect of the U.S. Postal Service is the only American corporation which must keep its pension fund fully funded for its pension outlays. Every other corporation, like General Motors, they probably have in their pension fund about 1/4 of what their pension obligation is at any one time. They don't have to keep it fully funded. So pensions sound like a really good idea, and I know they are. I mean, I'd love to have a pension. I don't have one. I never would work long enough and name my company to have a pension. But sooner or later, the Pension Benefit Guarantee Corporation is going to have to come in and cover a bunch of pensions because companies are going to go out of business. What happens when Sears and Roebuck goes out of business, or J.C. Penney, or Kmart? These people, when they go out of business, the pensions money won't be there, and they'll have to step in. The pension benefit will have to step in and supply the money for the pensioners, and they'll use up all the money they have stored. And where they're going to have to go? They have to go to Congress and get more funding, and the taxpayers will wind up paying for it. This is all side issues, but it's aspects of investing. Mutual funds, you can lend money to somebody if you wanted to. You could be your own, you could hold mortgages for people if you wanted to. I know people invest and they buy houses and they rent them out. My mother did that. She would go to public auctions at the courthouse where they would sell foreclosed houses. The state or the city had foreclosed on a house because they hadn't paid their personal real estate taxes, and they owned it, and then they just auctioned it off at the courthouse to whoever was there, and it would sell for whatever price somebody was willing to pay for it. So my mother bought several houses and then rented them, and it was a nice stream of income coming in off of rents. And you can do that, and there are people who do that. I had an old boss, he owned like 6 houses at the time, and it was providing a nice income stream. Of course, he had maintenance that had to be done on those houses, and he'd get a call at 3 o'clock in the morning. My heat's off. My heat's off. That's an aspect of it. But if you know how to do that and you're willing to do that, then that's an investment option for you. You can do real estate. You can do debt. You can do equities. You can do minerals. You can do invest in corporations worldwide that only make whammos or something. Drug companies throughout the world, or mining companies throughout the world, or you can invest only in a single country or in a region of the world like the Pacific. Vietnam and Thailand and Japan and all those countries, their economies, like India. India has a stock market. So does China. So does most countries. They have stock markets, and they have buy and sell stock for companies in that country. You can invest in those stock markets via mutual funds. I wouldn't suggest any other mechanism to do it, but you can. Another type of investing, which I keep forgetting, is cryptocurrency. I got hot a couple years ago. You buy, and it's not easy as it sounds, but you can buy crypto coins, and they were just magically going up because more and more people wanted to have crypto. At one time, crypto coins were really the black market money exchange standard. If you wanted something, if you wanted heroin, you could buy it on the internet if you used crypto coins because it wasn't traceable. Okay, that's the idea of crypto coins. The transactions are not traceable, i.e., governments don't know about them. So you could buy and sell and do whatever you want underneath there, and they would never know about it. So various entities in the world like that idea, so they drove the price of cryptos up. And you as an investor, hey, I want to get into crypto coins and all these various other forms of electronics that skirt around banking issues in terms of traceability. Okay, well, that's you're investing in ether, basically. The only way that really ever works if you bought in at 5 and when it hit 20 you sold it and got out of it. And it's like a Ponzi scheme. It'll keep going up as long as there's another sucker who's willing to pay more for it than the last guy did. But it eventually explodes. There's not enough people buying it and driving the price up. And then people get scared and they start selling it off, and they'll take whatever they can get for it, and it keeps dropping down and down and down and down. That's the nature of that, and I have no need nor desire to do that. And people say, well, you're missing a great opportunity here because the world's going crypto. And that may be the case. I may be just stupid as hell not doing crypto, but no thanks. It's no tangible anything anywhere. Don't even know where it is. Anyway. This is too much. This is more introduction to investing. I'll finally get around to many of the real aspects of it. But I want to highlight again: if you came into money, you inherited money, you hit the lottery. I don't know what happened. You retired, you got a pension, it's only paying this and not cutting the mustard. I'd like to use my pension money over here. Then you need to start learning about it, about investing. And there are tons and tons of books and you should buy a couple of those, and you should read them and try to understand. Maybe meet a broker, someone who manages the money for you. Maybe that's the way to go. If you're a woman, I'm not slamming sex. I'm not sexist. I'm not saying that, but some people just don't want the hassle of it, and they just hire somebody to take care of it all for them. And you can do that. A lot of the big actors and actresses and stuff, they don't manage the money. They all have money managers. Sometimes it works fine, sometimes it doesn't. You wind up paying them a good chunk of money, but if they make you money and tons of money, why not? Let them take care of it. Anyway, that's enough. This is Introduction to Investing Part 2 of whatever. Uncle Ron and stuff. Today is the 7th of November. It's election day. And I've been trying to look on the web to see maybe some preliminary polling results, and I don't think they even do that anymore. They've been so unreliable. In fact, polling in general has been very unreliable in the last 3, 4, 5 elections, last 10 years. They just can't seem to get it right, and I think the truth of the matter is people lie. They come out and say, well, yeah, where you stand on this? Well, and the pollers are usually hired by somebody, and they're looking for something, and they try to find it. So anyway, side point. Uncle Ron and stuff money. I hope this is valuable sometime, somebody at some time, somewhere.